You're staring at gold headlines again, and you're missing the quiet stampede happening one aisle over. Because while gold gets the front page, platinum just pulled off the most dangerous kind of rally, the one that doesn't look like a rally until it's already gone. As of this week in 2026, platinum has surged roughly 36% since January 1st, and ripped to a record print around 2,771 won O's after a violent single-day jump of about 5% on January 23rd. Gold is strong, silver is loud, but platinum is doing something different. It's outperforming because the market finally woke up to a simple truth. Platinum isn't just another metal, it's a bottleneck. And when a bottleneck gets noticed, price doesn't negotiate, price revalues. If you only watch gold, you'll think the story is fear. But platinum's story is shortage meeting necessity. Tonight, I'm going to show you the three forces that turned platinum from a sleepy discount metal into the fastest horse in the hard asset race. 1. A supply chain that's structurally cracked. 2. A demand shock that arrived early. 3. A rotation trade that's forcing industry to choose the cheaper catalyst right now. And at the end, I'll give you the don't get wrecked checklist, because platinum moves like a scalpel one day and a sledgehammer the next. Let's start with the part no one wants to admit. The catch-up trade. Rare, discounted, ignored. For years, platinum traded at a discount to gold like it was the backup singer. That was the mispricing. Platinum is roughly 30 times rarer than gold in the Earth's crust, yet for a long time it was valued like a secondary industrial material. Investors treated it like palladium's quieter cousin, and traders treated it like a mean reversion toy. But 2026 is different because the market's psychology is flipped. When you see a metal with strategic demand, concentrated supply, and low above-ground buffers, you stop asking, what's fair? You start asking, what if we can't get it? That question is the spark behind this silent surge. Old price chart, platinum below gold for years. Overlay, discount era, normalization era. And what does normalization look like? It looks like platinum running to close the gap, because the old discount assumed supply was stable and demand was optional. Neither assumption is true anymore. Supply. The South African bottleneck is a satinahawa. Now we hit the uncomfortable reality. The world's platinum supply chain is geographically fragile. South Africa produces about 70% of global platinum. Read that again. 70%. If you're building your entire industrial ecosystem on a catalyst that mostly comes from one country, you don't have a supply chain. You have a single point of failure. And in 2026, that point of failure is flashing red. Here's what's happening inside the South African mining system. Years of underinvestment are now showing up as operational collapse. Energy costs are climbing. The power grid is unreliable. Load shedding isn't a headline anymore, it's a schedule. Labor disputes and logistics friction keep output from stabilizing, so when demand ticks up even slightly, there's no elastic response. Mines can't just turn on a new supply stream like a factory switch. That's why the platinum market walked into 2026 with a deficit backdrop. Industry analysts and platinum market watchers have been warning about multiple years of deficits and shrinking above-ground inventories. By late 2025, estimates of remaining above-ground cover fell toward roughly 5 months of demand. 5 months. That's not a safety buffer, that's a fuse. And it gets worse when you add geopolitics. Russia is a major producer of platinum group metals, and sanctions dynamics continue to distort flows and investor comfort. So the world effectively leans even harder on South Africa. At the exact moment, South Africa's system is strained. This is what I mean by bottleneck. Not because there's no platinum on Earth, because the pipeline that turns ore into deliverable metal is narrow, stressed, and politically sensitive. In a bottleneck market, a headline can move price. But more importantly, procurement departments don't wait for headlines. They front-run them. Why structural decay isn't a buzzword. When people hear South Africa bottleneck, they picture politics. The bigger issue is mechanical. Many platinum mines are old, deep, and expensive to keep running. That means if the grid fails, you don't just lose a day, you lose ventilation, pumping, hoisting schedules, the whole chain. If energy costs spike, margins vanish fast, and producers delay development work that would stabilize output later. If labor negotiations stall, restarting isn't instant. Safety checks and ramp-ups create real delays. And then there's refining. Platinum isn't sold as ore. It has to be processed into high-purity metal. Smelters and refineries are the choke point between rock and deliverable ounces. Disruption there translates into immediate tightness. Recycling helps, but it's not a magic tap. Recycling depends on scrappage rates and vehicle turnover. If fleets last longer, and policy signals just extended that recycling doesn't surge on command, it lags. So when analysts talk about thin above-ground stocks, picture a warehouse shelf with only a few boxes left. Estimates of remaining cover near the end of 2025 fell toward roughly 5 months of demand. That's why a 5% day isn't crazy, it's rational repricing. The invisible buyer, procurement. A retail trader buys because price is moving. A procurement team buys because stopping production is unthinkable. If you run a plant that needs platinum catalysts for emissions compliance, chemical processing, or fuel cell components, your nightmare isn't, "I paid too much." It's, "I can't deliver." So when procurement hears supply is concentrated, power reliability is unstable, inventories are thin, they secure the line, even at uncomfortable prices. That's why the rally feels silent. The biggest buyer isn't posting screenshots, they're signing contracts. 2 myths that keep people blind. Myth 1. Platinum is only industrial, so it can't be a haven. In 2026, strategic industrial metals behave like security assets because access itself becomes the hedge. Myth 2. If platinum was rare, it would always be expensive. Rareness alone doesn't set price. Rareness plus choke points plus non-optional demand does. All the platinum ever mined could fit into a small living room, so when price finally moves, it moves like a crowd, realizing the exit door is smaller than they thought. The price story, in plain English. Here's the simple timeline. 1. Platinum lives in the discount box while gold gets the prestige premium. 2. Deficits chew through buffers quietly. 3. Policy shifts extend catalyst demand. 4. Hydrogen procurement starts buying early. 5. Substitution out of palladium accelerates. 6. Investors notice the mispricing and the chart gaps. Yes, a weaker dollar and shifting rate expectations lift the whole precious complex, but platinum's outperformance is the tell that a scarcity premium is being priced in. Demand. The 2 shocks that blindsided the bears. If supply was the dry forest, demand was the match, and in late 2025 into early 2026, 2 matches landed almost back-to-back. Shock 1, Europe's ICE policy U-turn. For years, the global assumption was internal combustion is dying fast. That assumption capped platinum demand projections for catalysts. Then Europe signaled a tactical retreat from its effective 2035 combustion engine ban. Translation, more ICE and hybrid vehicles remain in the forward plan than the market was pricing. More vehicles means more catalytic converters. More catalytic converters means more platinum demand. Shock 2, hydrogen moved from future pitch deck to procurement line item. Platinum is a critical catalyst in proton exchange membrane, PEM fuel cells. That's the heart of many hydrogen applications. Now, hydrogen adoption isn't uniform, and it isn't simple, but here's what matters for price. Industrial buyers don't buy narratives. They buy inventory when they fear shortages. As heavy-duty trucking, shipping trials, and infrastructure spending accelerate, the platinum requirement becomes a real constraint. And even if hydrogen is 11% of demand by 2030 on some projections, the buying pressure can show up years early because manufacturers stockpile to avoid production stoppages. Remember this rule. Markets price the marginal buyer, and the marginal buyer in platinum right now is not jewelry. It's industry that cannot substitute away without breaking performance or compliance. So, platinum got hit from both sides. Catalysts stay alive longer than expected. And new energy tech starts pulling demand forward. That's how you get a surge that looks sudden. It wasn't sudden. It was delayed recognition. The palladium-to-platinum shift, substitution in real time. Now let's talk about the rotation traders noticed in the last hour, because this is the tell. For nearly a decade, palladium was the expensive sibling, especially tied to gasoline engines. As palladium prices ran, manufacturers did what manufacturers always do. They redesigned, not overnight, not for fun, but because cost pressure is a law of physics in industry. So the industry started substituting platinum back into catalyst systems where feasible. It's not a meme, it's engineering. And here's why the shift matters now. Palladium's demand base is narrower and more exposed to a shrinking gasoline fleet. Platinum's demand base is more diversified. Diesel, hybrids, industrial catalysts, jewelry, medical uses, and increasingly hydrogen applications. So when capital rotates, it does 2 things at once. It sells the metal with the narrowing story and buys the metal with the widening story. That's how silent rallies become unstoppable. The flows are not emotional, they're structural. Why this outperforms gold in 2026 historic year. Gold is the ultimate monetary hedge. Platinum is becoming a strategic industrial hedge. Gold reacts to fear, rates, currency credibility, and central bank behavior. Platinum reacts to those things too, but it has an extra engine, physical necessity. In 2026, you're watching an era where the market is repricing critical materials the way it reprices energy. And platinum fits that theme perfectly. Concentrated production, unstable power inputs, thin above-ground stocks. demand that can't be delayed without consequence. So yes, gold can run on headlines, but platinum can run on procurement, and procurement doesn't care about your RSI. What happens next? 3 paths. It's like, now we get tactical. If platinum just tagged the high 2700s, what's next? Path A, the cool-off that scares retail. After a vertical move, you often see a sharp pullback. That doesn't mean the thesis died. It means leverage got rinsed. Path B, the grind higher that bores everyone. Price consolidates, open interest shifts, and physical tightness remains. This is how big revaluations build a base. Path C, the gap move that rewrites the range. A supply disruption, a policy shock, or a procurement panic hits and platinum reprices in a weekend. If you're asking which one is guaranteed, here's the honest answer. None of them. What's more predictable is volatility. Because platinum is a smaller market than gold, it doesn't take much flow to move it, and when it moves fast. What I'm watching this week. The fastest tells are not opinions, they're constraints. Headlines on South African power cuts, any refinery outage chatter, EU auto policy language, and hydrogen order announcements. If those tighten while price holds, the silent surge isn't finished. Stay sharp. The don't get wrecked checklist. So, all right, here's the survival kit. Not financial advice, just how to think like you're protecting capital. 1. Respect position size. Platinum is not a sleepy bond. If you size it like gold, it can humble you. 2. Don't chase candles. If you buy the top of a vertical day, you are volunteering to be liquidity. 3. Track the real drivers, not the noise. Watch South African power and labor headlines. Watch policy shifts that change catalyst demand. Watch substitution narratives between palladium and platinum. Watch inventory language from market reports. 4. Know your vehicle. Physical, futures, ETFs, miners, they do not behave the same. Each has a different risk. Storage, roll yield, leverage, geopolitical company risk. 5. Have an if I'm wrong exit. In a bottleneck market, being early can feel identical to being wrong. Your job is to survive long enough for the thesis to pay you. And here's the part I want you to remember. Platinum's move isn't random. It's the market pricing a supply chain that can't scale and a demand base that is getting less optional. That's why it's outperforming gold right now, because gold is the alarm bell. Platinum is the missing part. The silent surge thesis in one sentence. If 2025 was the year people learned that money can be printed, 2026 is the year they learn that catalysts can't. If you want a follow-up episode, comment Platinum Checklist and tell me which angle you want next. South Africa supply, hydrogen demand, or the palladium substitution war. And if you're tracking this rally in real time, hit subscribe, because the next move won't announce itself. It'll just happen.